All right, everyone, this week I dove into a little ChatGPT Google Trends to look at what are some of the trending topics in real estate. And to no surprise, with a lot of real estate appreciation in the last 10 years, one of the topics that was up over 160% was capital gains tax. So we're gonna jump into what is capital gains tax and ways that you can help offset some of the taxes you could be paying. So let's jump in. All right, everyone, so before we get started, don't forget to like and subscribe. Hope you enjoyed this video, and thanks for letting me share some of this info with you. So first off, what is capital gains tax? Capital gains tax is the gains or the profit when you sell either your residential primary home or an investment property. Now, the tax is only paid on the gains. So if you buy a house for $700,000 and you sell it for $1 million, you have $300,000 in gains or profits. So now there are a couple different ways to avoid or offset these taxes. Now it's important to understand when looking at how to offset these taxes, what type of property you have. Is it a primary residence or is it an investment property? And there are different means and different ways for offsetting these taxes. And a lot of people get confused. There's some confusion around the two. So an investment property, you can do what's called a 1031 exchange, and you can take that money and roll it into a similar like property. So if you buy a property for 500 grand and now it's worth $1 million, instead of paying the taxes on that, you can sell it for $1 million and within a certain time period, buy another property for $1 million. Now, at the end of the day, you're not really avoiding taxes, right? You're just pushing them down the road, because eventually, if you sell that property years and years, or you keep doing the 1031 exchange and eventually you sell the property, you're gonna have to pay taxes on something worth much more money. But it's a way to defer the taxes and maybe come up with some different plans with your financial expert on how to offset some of those taxes. Now, for your primary residence, there's a couple tax exemptions. So if you file your taxes as a single household member, it's $250,000. And if you are married, it's $500,000. So if you bought your place for $500,000, you're selling it for $1 million, and you're married, you're in good shape, you're fine. But let's say you're a married couple, you bought it a long time ago for $500,000, now it's worth 1.3, right? That's $300,000. That's probably getting taxed at a very high rate. So let's talk about some ways that you can cut back on the amount you are getting taxed on. So one way to offset the gains is by offsetting it with losses. Let's say, hopefully you didn't lose this much money in the stock market, but let's say you have $300,000 in profit or gains that you're gonna get taxed on. And let's say you have 50 different stocks that you're invested in, and one of them has done really bad and you've lost $50,000 in over the last 5-10 years. But you've held on to that stock, it's kind of gone up and down, mostly down because you've lost 50 grand. Now you can sell it in the same year that you sell your home, and that loss of 50,000 will go against the 50,000 of your gain. So now instead of 300, you have 250. Another way is by offsetting it with things that you've put into the house that's helped you get that 1.3 price. So any upgrades, kitchen, bath, windows, upgrading electrical, things that money that you've put into the house. Definitely go over with tax professional on exactly what those things are and make sure you're keeping track of them. Now that can be a difficult thing too. Some of these things are done 5-10 years ago and you're trying to recollect them when you're going to sell. So definitely find good ways to keep track of that digitally, keep receipts. One thing that I think is great, this is not sponsored, but Copilot is an incredible app I use. It uses AI to every single expense I make. It categorizes it. You can even teach it to learn different sections, categories to put things in. Great app. I could do a whole video on that, but I'll just leave it there for you to do the research on. The other thing you can use to write off the gains are costs of selling. So maybe that's having a staging company come in. Maybe that's hiring a real estate professional. Any of those fees and costs that you incur when selling can go against that profit. So those are just a couple of the ways that you can offset some of the profits for capital gains tax. Now, a lot of people confuse the two. If it's investment property, you can only use the 1031 exchange. If it is your primary home, you can only offset either the 250 or 500, depending on how you file your taxes. Now, a good question I get is, when does it go from a owner-occupied property to an investment? Can it go back and forth? Can it change? Technically, yes, it can. And here's how it defines a primary residence. You have to have lived in it for 2 of the last 5 years. And it doesn't have to be consecutively. So if you live in it for a year, handful of years go by, or maybe Airbnb it, short-term rental in the midterm, then you come back, you live in it for another year, and there's been a 2-year period in the 5-year window, it's still your primary residence. We've actually had clients come to us that have sought our opinion on selling. They haven't needed to sell to buy their next place. And one of the things we've encouraged them to do, especially if they're in an area where we think there's a good appreciation for the next couple of years, we've encouraged them to rent, make some money, also make some money on appreciation. And then right before that 5-year window closes, sell and still be able to use the 2 out of 5 year rule. Another great question I get is, how many times can I use this primary tax exemption? You can use it as many times as you want. You just can't use it the next year after you just sold. So they wanted to really make sure it's your primary home. So there needs to be a 2-year window between those 2 homes. So if you do sell your primary residence, you're in another home, as soon as you're in it for 2 years, you can close on that and still use that $250,000 or $500,000 exemption. I hope this was helpful to you guys. Again, I'm not a CPA, I am not an accountant of any kind, so definitely if you have any further questions or want to look into the intricacies of this, definitely reach out to an accountant. If you don't have a great one, I got a great one in this area I can steer you towards. But yeah, if you have any questions, feel free to reach out. Don't forget to like and subscribe. And yeah, anything else comes up, you know who to reach out to. Have a great rest of your week.